The committee will come to order. Without objection, the chair is authorized to declare a recess of the committee at any time. Without objection, members of the full committee not on this subcommittee are authorized to participate in today's hearing. This hearing is entitled Examining the Availability of Insurance for Nonprofits. And I now recognize myself for 2 minutes to give an opening statement. Again, welcome to our hearing. And the Nonprofit Property Protection Act would allow risk retention groups, or RRGs, to insure the property of their small and mid-sized 501c3 nonprofit members. In addition to the liability insurance they already provide, the bill seeks to address concerns that these small nonprofits have very few choices and are struggling to get access to the property insurance coverage that they need. At its core, this hearing is about nonprofits having the resources that they need to do their jobs. One of these resources is access to adequate and affordable insurance coverage so that the nonprofits can do their jobs with peace of mind, that their valuable work has a backstop in the case of an accident. I believe that Nonprofit Property Protection Act is a narrowly tailored attempt to amend the Liability Risk Retention Act of 1986 in order to address a specific need from a relatively small segment of the market. Research from Guy Carpenter has demonstrated that only one admitted carrier offers a standalone property and auto physical damage policy, and only a handful of bundled policies are available to small and mid-sized nonprofits. An RRG for nonprofits cannot survive without the availability of property and auto physical damage insurance, but commercial insurers will not provide this RRGs, and RRGs are forbidden to do so by the federal law which governs them, the Liability Risk Retention Act. When property is offered by the few companies that will insure a nonprofit at all, it is only offered as part of a package policy, including liability insurance, which members of RRGs don't need or want. And 6 states have passed laws, 2 as recently as 2014 and 15, to allow nonprofits to expand unregulated risk pools for liability and property. And I will stop there and yield to my friend from Texas, Mr. Green.
Thank you, Mr. Chairman, for yielding, and I thank the witnesses for appearing. Mr. Chairman, I'm proud to speak on behalf of the legislation, and I thank you for holding this hearing today so that we may have an opportunity to vet some issues of concern and to move the bill forward with appropriate input. This bill is supported by some 1,600 different entities. I have here letters from the 1,600 that I speak of, and they range from Black Lives Matter to the insurance company or entity, I should say the RRG, that has associated with it some 133 institutions, and these are HBCUs, historically black colleges and universities. It also is supported by the National Assembly, Human Services Assembly. This is an association of not-for-profits. The bill is quite simply this: an opportunity for these 501c3s, not 4s, to have insurance for property such that they can buy it from a standalone perspective. Currently, if they seek to purchase such insurance, they have to purchase it as a part of a package deal, as was indicated by the chairman. And in this package deal, they have to purchase the liability as well as the property insurance. Well, this affords the RRGs to allow for the coverage of property by purchasing it from, by self-insuring, excuse me, as opposed to having to purchase it from a commercial company. I think it's a good piece of legislation, and I look forward to talking to my colleagues more about it so that we might move it forward. Thank you, Mr. Chairman. I yield back.
Thank you, Mr. Green. And now I recognize the ranking member from Texas for 5 minutes for an opening statement.
Thank you, Chairman Clay, and thank you to our witnesses for being here today. I'd like to start by briefly stepping back and looking at the bigger insurance picture as it relates to this hearing. In the 1980s, the national insurance marketplace faced an availability crisis in the commercial liability space. There was a hard market, and Congress enacted the Liability Risk Retention Act, a law that created risk retention groups known as RRGs, and those were set up under a unique regulatory structure that helped solve what was a serious problem at the time. And today they help by servicing a specific part of the insurance spectrum. We have a bill before us today that will allow these RRGs that serve nonprofit organizations to offer additional types of commercial insurance. Proponents, as I understand, argue that expanding the LRRA point to the idea that an insurance availability problem exists today. They also argue that nonprofit organizations are unable to easily acquire property coverage from the traditional marketplace. And while they do provide an option to those who would otherwise have limited options, I'm more concerned about some of the potential impacts and unintended consequences that I'd like to discuss here with you all today with the panel. Currently, RRGs operate nationwide, but are only subject to the regulations of the state in which they are domiciled, as opposed to traditional admitted insurance companies, which must abide by the same insurance laws of every state in which they offer policies. Questions that I'll have for you today are: how would an expansion of the law impact risk calculations and ultimately ensure we're providing the important regulatory protections that Americans have come to expect within the insurance space? Furthermore, would expanding the LRRA so RRGs can offer commercial property insurance even be consistent with the original intent and reasoning of Congress when RRGs were first established? These are just some of the questions that I hope to hear from you all today. I realize there are competing voices, and I look forward to the discussion, and I yield back to the chairman.
I thank the gentleman for yielding back, and today we welcome the testimony of an excellent panel of witnesses, beginning with J. Robert Bob Hunter, Director of Insurance Consumer Federation of America, and followed by Ivoree Robinson, Vice President, Property and Casualty, ABD Insurance and Financial Services, Inc., and someone that I'm very familiar with, Chlora Lindley-Myers, the Director of the Missouri Department of Commerce and Insurance on behalf of the National Association of Insurance Commissioners, Pamela E. Davis, Founder, President, and CEO, Nonprofits Insurance Alliance. And last but not least, Mr. John Bergner, Assistant Vice President, Public Policy and Federal Affairs, National Association of Mutual Insurance Companies. Welcome to you all, and let me remind you before you begin that your oral testimony is limited to 5 minutes. Without objection, your written statement will be made part of the record. Mr. Hunter, you are now recognized for 5 minutes. Please turn on your microphone. Not yet. Okay.
The light has to come on.
It's a red light. Can someone help Mr. Hunter with his? You got it? Okay, speak into your mic directly, please. All right. It's still not on. Hold up. Someone give him some assistance, please. Okay. So sorry for the delay. How about now? What do we have going? Malfunction.
Maybe I should go somewhere else.
Oh, I think he's on.
Okay, let me, pardon? Yeah, I'll go. Oh, wait a minute, we got it.
Does this work?
Yes.
Okay.
You are connected.
I'll have to come over a little bit.
All right. Go right ahead, Mr. Hunter.
My name is Bob Hunter. I'm Director of Insurance at Consumer Federation of America. I have been Texas Insurance Commissioner in the past, and I've been involved in insurance consumer advocacy for 40 years, and after 15 years in the private sector and 10 years as Federal Insurance Administrator at HUD, which now is, of course, at FEMA. In the mid-1970s, America faced its first liability crisis, and President Ford, in my view, wisely created an interagency task force in 1975 to look into the cause and solutions of the problem. I was on that task force, and we made recommendations later under President Carter to do two things: to change the annual statements of insurance companies so we'd have better data if we ever faced another crisis like this. And two, we suggested that the product liability line was not competitive and needed greater coverage availability, and we proposed the creation of a Product Liability Risk Retention Act. A bill to achieve that was filed in 1979 and enacted in 1981. The 1981 Act was just product liability insurance coverage. We had another crisis in the mid-1980s, which was even worse. Rates were going up even faster and less availability. The second crisis, we had the data. We saw that the problem was the economic cycle of the insurance industry, not an influx of claims. As president of the National Insurance Consumer Organization, I testified over the country. I testified in every state in 1986 and several times here in Congress. In reaction, the Congress in 1986 voted to expand the Product Liability Risk Retention Act to what it is today, the Commercial Liability Risk Retention Act, in effect. In 2002, there was another bit of a crisis in the wake of 9/11, and we proposed at that time expanding the Liability Risk Retention Act to cover all property casualty insurance to get over that trouble. That didn't happen. Today, I'm here to support a much narrower expansion under House Resolution 4523 that asks Congress to require those states with insurance markets that fail to address the property insurance need of nonprofit organizations to authorize only very experienced and very stable liability RRGs to provide the coverage. Risk retention groups that cover the liability insurance needs of nonprofit groups have served the nonprofit sector well over the past 30 years. Nonprofits that also have property insurance need to go to the private commercial market for that coverage. However, there's significant evidence that there's not a competitive market among private commercial carriers offering standalone property coverage, and in some states, in the wake of catastrophes, there's no market. In 2017, a study by Guy Carpenter was mentioned earlier documented this problem. There was only one company writing standalone coverage, and we're told that that one company may leave the market, which would leave no companies writing the standalone coverage. Some say, well, why don't these nonprofits buy the package policies like the business owner's package? The problem is that those policies don't cover what they need in liability. One of our member companies who does consumer advocacy was offered a policy, but it wouldn't cover consumer advocacy. And that was the only policy they could find. And so what we need is policies that are designed for these nonprofits, and these nonprofits deal with all kinds of tough situations. Using volunteers, usually, they're into situations like homeless situations with drug abuse, sexual abuse, all kinds of wonderful services that we really need. They need the kind of coverage that actually fits their model, their real risk. There's an important federal role in establishing this eventuality. The bill is very safe, I think, and provides enough protection for these consumers who are, in effect, who own these RRGs, and they're insuring themselves really through these RRGs, so they're not going to try to just, cheat each other themselves. And they do have strong standards for solvency in this bill. No RRG that has existed for 10 years or more, which is the standard in the bill, has ever gone insolvent. Now, some have said, well, what about, shouldn't they be covered by the guarantee funds? And I am willing to say that CFA would support amending the bill to allow risk retention acts to go into guarantee funds, although I don't think it's absolutely necessary the way the bill is drafted.
Thank you, Mr. Hunter. The chair now recognizes Ms. Chlora Lindley-Myers for 5 minutes.
Oh, sorry. Wait a minute. Let me get this. I stole it from her. She doesn't have theft insurance either.
Thank you for the opportunity to testify here today. The NAIC believes that nonprofit organizations serve a critical role in our country, and we recognize the importance of ensuring that they have access to insurance that meets their need. We understand that some have raised concerns regarding the availability of commercial property coverage for nonprofits. They've also argued that H.R. 4523, the Nonprofit Property Protection Act, is the appropriate mechanism for addressing such concerns. On both accounts, we respectfully disagree. While the passage of the LRRA may have been viewed as appropriate in the 1980s to address a widespread availability crisis in the liability insurance market, no such crisis exists today in the commercial property insurance market. Traditional admitted carriers do provide coverage to small and medium-sized nonprofits, albeit several offer it in the form of a full business owner's policy that contains both liability and property coverages. Also, if there are limited options for a specific policyholder in the admitted markets, policyholders have access to surplus lines markets as well as the residual market. State insurance departments have received few, if any, complaints from nonprofit policyholders indicating that they're unable to obtain the coverage that they require. Notwithstanding any questions surrounding availability, we're troubled by the idea of less regulated RRGs providing commercial property coverage. Even though RRGs may operate in multiple states, they're only required to be licensed in one, and the regulatory authorities of non-domiciliary states are significantly curtailed. These limitations are significant because RRG policyholders do not get the benefit of the oversight that multiple sets of eyes can offer. This is particularly concerning as only 30% of all RRGs write business in their state of domicile, which means that state has limited firsthand exposure to the RRG's conduct and policyholders. Under H.R. 4523, an RRG already subject to weaker regulatory requirements based thousands of miles away with no presence in Missouri would be able to write property coverage for Missouri policyholders, and I would have limited oversight or ability to act to protect those policyholders should anything happen. I couldn't even conduct a market conduct examination to determine if they were bad actors. Further, while it is true all states are required to establish a baseline level of regulatory requirements for RRGs to obtain NAIC accreditation, those requirements are specifically designed for the purpose of RRG regulation. They relate to the liability lines of business RRGs are entitled to write, are subject to the limitations in the LRRA, and are not the same as the admitted market. The minimum capital requirements are different. The types of assets that can be used for capital are different. The accounting basis can be different, and as a result, the threshold for intervention can be opaque to regulators. Historically, RRGs have had a higher rate of insolvencies. Over the past 10 years, RRGs entered receivership at nearly 2 times the failure rate of admitted carriers. In the event of an insolvency, RRG policyholders do not have the same protections as the admitted market. The LRRA prohibits RRGs from participating in the state guarantee fund system. So unlike buying from a traditional insurer, nonprofits have no safety net should their RRG fail. My written testimony provides additional details regarding options for RRGs that wish to provide property coverage to their members, such as converting to an admitted carrier or affiliating with one. Expansion of the LRRA, however, is not the appropriate solution. In conclusion, we're concerned that preempting the states to allow RRGs to sell commercial property coverage would create more risk for RRGs and ultimately their policyholders. The limited oversight of non-domiciliary states in the RRG regulatory framework, coupled with the lack of state-run guarantee fund protection and increased risk of insolvencies associated with RRGs, could expose nonprofit organizations and those who rely on them to unnecessary risk. I thank you for this opportunity to testify today and would be pleased to answer any questions you may have.
Thank you, Director Lindley-Myers. The chair now recognizes Ms. Ivoree Robinson for 5 minutes.
Chairman Clay, Vice Ranking Member Gooden, and members of the subcommittee. I am Ivoree Robinson, Vice President of ABD Insurance and Financial Services, an insurance broker. Thank you for the opportunity to testify today about the difficulties small community-based nonprofits face finding appropriate property casualty insurance. In doing so, I will describe my experience trying to obtain coverage for one of my clients, Black Lives Matter, and explain why I believe risk retention groups must be able to offer property insurance to their nonprofit members. ABD Insurance and Financial Services is one of the fastest growing private insurance firms in the United States. We work extensively, directly with nonprofits to help them obtain property casualty insurance that is appropriate for them and that they can afford. Our clients serve our communities in a variety of ways. They help those with disabilities such as cerebral palsy, Down syndrome, and autism. They rescue thousands of pets, provide care for the sick and injured. They work with those addressing global problems, including climate change, inequality, and food insecurity. While this variety and creativity is extremely good for our communities, it can be challenging for insurance companies to tailor affordable insurance for them. Even in the best and most competitive of insurance markets, nonprofits always seem to be at a disadvantage. Out of the more than 150 companies that we represent and work with, only about 3%, yes, just 3%, are focused exclusively on helping nonprofits with specialty insurance that they need and helping them to thrive in the communities that they serve. None of those companies provide standalone property that small nonprofits need to pair with the liability insurance they obtain from their own risk retention groups. I began actively working with the risk retention group for nonprofits several years ago. As with all insurance companies I work with, I made sure that the risk retention group offered appropriate insurance policies, had a good reputation for fairly paying claims, and was financially strong. Unfortunately, there are a couple of trends occurring simultaneously in our industry right now that are making securing affordable insurance even more difficult for small community-based nonprofits. First, there's an increasing trend towards automation within the insurance industry. While this makes good sense for insurance companies hoping to shrink their operating margins, but it does not work well for organizations who are community-based like nonprofit. That does not fit into their underwriting box due to their own unique services that nonprofits offer. In addition, despite the opponent's assertion that there is no crisis at this time, the insurance industry right now is in one of the most hard markets we have seen in decades, which means sharp increases in premium for all policyholders in 2020 and beyond. The insurance markets have suffered record claims and losses due to wildfires, hurricanes, flood, increased litigation around sexual abuse, and we can expect those trends to continue. This has resulted in decreased market capacity to provide coverages, increases in premiums as much as 100% for policyholders, and unprecedented numbers of cancellations and non-renewals. In fact, today, one of the largest nonprofit insurance companies informed brokers they are canceling coverage for all foster care agencies, adoption, and housing-related nonprofits at renewal this year, which could begin as soon as March for bundled insurance products. I would like to close with one example of why it is extremely important that risk retention groups continue to exist. I am the insurance broker for Black Lives Matter. My experience of trying to find insurance for them has solidified my support for risk retention groups and their important role, particularly in supporting new and emerging community-based organizations and civil justice organizations. I spent nearly a year, endured rejections from over 90 traditional and admitted insurance carriers and companies with my efforts in trying to find coverage for Black Lives Matter. Insurance underwriters reacted to sensational headlines rather than examining the actual operations of this organization. Ultimately, it was nonprofits' own risk retention group that provided their necessary coverage. Without insurance, organizations like this cannot obtain financial support through fiscal sponsorship, rent facilities, receive permits to hold rallies, raise funds for government resources, engage in services that individuals are willing to provide for a volunteer basis for their nonprofit board members. I am proud of the industry I've chosen for my career, but this experience made me see very clearly how not having access to insurance can impede the important work of our community organizations. We have found that risk retention groups, their solution to be an excellent one for small and mid-sized community-based nonprofits. We cannot stress strongly enough how important it is that HR 4523 become law so that well-capitalized and seasoned risk retention groups are able to provide this important property insurance to their nonprofit members. Thank you.
Thank you, Ms. Robinson. The chair now recognizes Mr. Bergner for 5 minutes.
Thank you, and good afternoon, Mr. Chairman, Ranking Member Gooden, and members of the subcommittee. Thank you for the opportunity to testify here today. My name is John Bergner, and I am the Assistant Vice President for Public Policy and Federal Affairs for the National Association of Mutual Insurance Companies. NAMIC membership includes more than 1,400 regional and local mutual insurance companies on main streets across America, as well as many of the country's largest national insurers. Though not 501c3s, mutual insurance companies are also not-for-profit organizations, which exist solely for the benefit of their policyholders, and so share a certain affinity for those entities that are the subject of today's hearing. In speaking on behalf of NAMIC's diverse and unique membership, which is made up of many of the nation's smallest insurers, we hope to provide a useful perspective for the conversation on nonprofit insurance and risk retention group expansion. I want to start by saying that NAMIC members are community leaders across America and support the work that many 501c3s do in our communities throughout the nation. However, we do not agree that a crisis exists in the commercial property market and believe that an expansion of the scope of risk retention groups would be unnecessary and inappropriate. Therefore, we are opposed to H.R. 4523, which we believe would needlessly undermine the state-based insurance regulatory system here in America. In short, NAMIC opposes H.R. 4523 for 4 key reasons. Number 1, no national insurance availability crisis exists that would warrant circumventing long-standing state insurance regulations. Number 2, because no crisis exists, allowing RRGs to offer commercial property and auto insurance would serve only to create an unlevel regulatory playing field and a competitive advantage for a handful of RRGs in this market. Number 3, the RRG regulatory regime is substantially different and less rigorous, undermining consumer protections and potentially placing 501c3 policyholders at risk. And number 4, states have already created more tailored and effective risk transfer mechanisms and alternative solutions for 501c3s. Simply put, NAMIC does not see compelling evidence that there is a national availability crisis in the commercial property insurance market for 501c3s. There are insurance coverages, including property coverage, available and, in some cases, marketed directly to nonprofit organizations. Allowing RRGs to sell the same commercial insurance products already offered in the admitted markets simply gives them an unfair competitive advantage over traditional insurance companies that abide by all of the regulatory standards and consumer protections of each state in which they operate. This is because, in contrast to admitted carriers, risk retention groups are allowed to operate nationwide, but they are only substantially subject to the regulations of the state in which they are domiciled. By definition, this means that there is less oversight by fewer regulators. Further, they are not required to participate in state guarantee funds designed to protect consumers. This arrangement was specifically designed to deal with a widely recognized crisis in commercial liability insurance markets in the 1980s. No such crisis exists today in the commercial property market. Even if one were to stipulate there was an availability issue for nonprofits, which we do not, it does not mean that passage of H.R. 4523 and the expansion of the RRG mandate is the only, best, or even an appropriate remedy. There are other mechanisms through which a nonprofit could effectively transfer its risk. If a nonprofit has real difficulty in finding the exact coverage it desires in the admitted market, it can have a broker go to the surplus lines market. In the event that an organization cannot find coverage in either the admitted or the surplus lines market, many states have residual market mechanisms, like FAIR plans, to which they can go to acquire a commercial property policy. And finally, in the event none of that works, a state could address any concerns about coverage availability on its own, working through the state insurance commissioners or the state legislatures on a tailored solution, like at least one state has already done in this space. NAMIC believes the issue is quite simple. If RRGs want to offer the same products as admitted insurers, they should play by the same rules. There was nothing novel about the structure of RRGs when they were created. The concept of an insurer that is owned and managed by and for the benefit of its policy-holding members has been around since the first successful U.S. mutual insurance company was founded by Benjamin Franklin in 1752. I would note that company is still in existence today. Given that NAMIC's membership contains numerous smaller insurance companies that write in multiple states for niche markets, we would invite any RRG not satisfied with the statutory limitations on its offerings to strongly consider reorganizing as an admitted mutual insurance company. As I close, I think it is important to highlight the fact that state regulators, independent insurance agents, and the entire primary insurance industry all agree that H.R. 4523 would undermine the state-based system of insurance regulation and increase risk to consumers. Again, thank you for the opportunity to speak here today, and I look forward to answering any questions you may have.
Thank you, Mr. Bergner. The chair now recognizes Ms. Davis for 5 minutes.
Chairman Clay, Vice Ranking Member Gooden, and members of the subcommittee, thank you for the opportunity to testify about the availability of insurance for nonprofit organizations and explain why the Nonprofit Property Protection Act is critical to assure uninterrupted insurance coverage for tens of thousands of nonprofit organizations. I'm the president, CEO, and founder of Alliance of Nonprofits for Insurance Risk Retention Group, known as ANNI, and I'm testifying on behalf today. ANNI insures small and mid-sized community-based nonprofit organizations across the country, those in our neighborhoods who work with the most vulnerable among us. There are homeless shelters and programs for those with Alzheimer's, victims of abuse, and the developmentally disabled. There are animal rescues, elder care services, drug and alcohol rehabilitation centers, school arts programs, and faith-based organizations. 80% of the member insureds have annual budgets of less than $1 million. These little nonprofits never wanted to be in the insurance business, but created their own insurance companies as risk retention groups against great odds because commercial insurance carriers abandoned them. And last year, ANNI, nonprofit's own risk retention group, experienced a 30% increase in applications as commercial insurance companies once again non-renewed restricted coverage options and raised prices on nonprofits. This year, we have seen the trend continuing to escalate. And as an RRG, we've been successfully insuring these organizations for difficult liability risks such as auto, sexual abuse, and employment practices for decades. We also offer free consulting and educational services such as employment risk management and driver training to nonprofits whose small budgets do not allow them to provide and purchase these services. But our future ability to serve nonprofits is now in question. Commercial insurers, when they're willing to offer insurance for small nonprofits, provide it only as a bundled package. That is, small nonprofits must purchase the liability and the property together, similar to a triple play cable package. However, by federal law, risk retention groups are prohibited from offering property insurance to their members. Only one company in the country offers a standalone property insurance program appropriate for small and mid-sized nonprofits that are members of a risk retention group. This program is meant to address the market failure until other commercial companies started to offer the product. Several years ago, the single company offering the property indicated that they intend to discontinue the program. We ask insurance brokers and agents who work with nonprofits to find other commercial insurance companies to provide the standalone property insurance for their clients. They told us in no uncertain terms there were no appropriate policies options available. Hearing that, we engaged Guy Carpenter to conduct an independent study to see whether there were insurance department filings that we had overlooked. Surely some other carrier provides this coverage. Guy Carpenter's research turned up no viable commercial options for the standalone property form for small nonprofits. We have exhausted all of our options for a market-based solution. To provide consumer protections, the Nonprofit Property Protection Act has minimum capital and seasoning requirements before any risk retention group can offer property insurance. And to make sure this bill will only correct a market failure, and not interfere with an otherwise well-functioning commercial property market, the bill has 3 additional provisions. 1, risk retention groups may offer property insurance only to their members that are 501c3 nonprofit organizations. 2, any single nonprofit may be insured by a risk retention group only for up to $50 million in total insured value, because it is presumed that larger nonprofits will be able to purchase these standalone coverages in the standard market. And this last point is critically important. No risk retention group may begin offering property insurance to its members if there are 3 licensed, admitted insurance companies offering these property coverages nonprofits need in a state as determined by the insurance commissioner. Let me emphasize that point. Under the provisions of this bill, any insurance commissioner can stop any risk retention group from beginning to offer property insurance simply by listing on its website 3 licensed admitted companies that write this coverage in that state. We have been asking insurance commissioners to provide us with the names of companies that will write this coverage for years, and they have not provided the name of a single company, nor have they suggested language to improve the bill. Every industry, even insurance, must make room for necessary and prudent innovation, like the Nonprofit Property Protection Act. Congress can correct a market failure that insurance commissioners and commercial insurance companies have either been unable or unwilling to fix. With H.R. 4523, nonprofits can solve this problem for themselves. Thank you.
Thank you, Ms. Davis. The chair now recognizes the gentleman from Texas, Mr. Green, who is also the chair for the Subcommittee on Oversight and Investigations, for 5 minutes.
Thank you, Mr. Chairman. I thank the witnesses for appearing as well. Let me start with you, if I may, please, ma'am, Ms. Lindley-Myers. Ma'am, you cited a insolvency rate earlier, did you not?
I indicated that RRGs is 2 times likely to fail.
And in citing your insolvency rate, you did not address those with experience of 10 years or more. Is this correct?
Well,
Is this correct?
that have 10 years or more.
Yes. Is it correct that you did not address them?
I did not mention that at all.
You did not mention it. And is it true that with 10 years or more, we've never had a single insolvency? Is this true? It is. And you neglected to mention it. Is it true that if you had your way, you would eliminate the RRGs?
That's not true.
You would keep them?
If they would operate under state, I would keep them if they would operate such that they would allow either combine themselves with an admitted carrier.
Let me continue. Is it also true that you've read the bill?
It is.
You've read the bill?
It is.
I take it, yes, you've read the bill?
I did.
Okay. In reading the bill, did you happen to note over on page 4, line 24, the statements that indicate that if there is a crisis, if there is no crisis, then there will be no RRG in a given state by simply certifying that there is not a crisis?
It indicates that if there is a crisis and the RRG is already operating, it doesn't say that they have to stop operating once it's determined that no crisis exists.
So if if we amended the bill to include language to accommodate you, you would then support it?
No, because I
But
feel.
then you just made the point that if there is no crisis, you would accept the bill. And if at some point the crisis does exist, if the crisis exists, you would accept the bill. But if there is no crisis, then you would want to return to a state wherein the RRG would not be allowed to do business in the state.
There is no crisis, and if there is an issue, as been mentioned by the chair when he was giving his 2 minutes, apparently the nonprofits have gone to states and said, hey, this is a problem for us in this state, and so therefore we want to correct it.
Well,
And in certain situations,
If I may,
those
my
things have
time is
done.
quite limited. If there is a crisis, we have one circumstance. But if there is not a crisis, the authorities in the state but only have to certify that there exist 3 companies that provide this type of insurance. So we cover the circumstance of a crisis. If there is a crisis, then they won't operate in the state. If there isn't, then the 501c3s can be accommodated. Let me ask you, ma'am, the lady that represents Black Lives Matter, I can't quite read your name from here. So
Ivoree Robinson?
Okay, Ms. Robinson.
Yes.
Tell me about the difficulty in acquiring insurance, please, for an entity such as Black Lives Matter.
Sure. What it comes down to is because they do unique services, they're not a one-size-fits-all type of organization. The stance of the insurance companies, if they don't feel comfortable with the risk, if they don't like any perceived liability based on whatever they find online or Google, whatever their own personal inferences are, they don't offer the coverage. This is why it took me more than a year. And Black Lives Matter is one of many organizations that have this difficulties. As I mentioned in my experience, I work with hundreds of nonprofits. In my experience, I would just ask anyone on this panel if they have had direct experience in working with nonprofits to place this coverage as opposed to just the legislative side.
Let me conclude with, Mr. Chairman, I'd like to put the 1,600 letters supporting the legislation into the record, and I would like to close with the bill having covered the question of a crisis in terms of whether it exists or not. If there is a crisis, then they operate. If not, they can't operate in this state. And no company with 10 years of experience or more has ever failed, and you neglected to mention that. I yield back.
Gentleman yields back. The chair now recognizes the gentleman from Texas, Mr. Gooden, for 5 minutes.
Thank you. The reason a state guarantee fund exists, I believe, which they're all active in all 50 states, is to protect policyholders if an insurance company defaults on benefit payments or becomes insolvent. Is that correct, Director Lindley-Myers?
That's correct.
So can you tell me, do these risk retention groups, do they have access to this state guarantee fund? Do they have access?
They do not.
So what does that mean moving forward? If we're using the history of no insolvencies as a benchmark, then why do we even need these state guarantee funds?
The state guarantee funds exist to protect policyholders. If an RRG fails, they are not a part of the state guarantee fund, so therefore the assets of the nonprofit would have to be used to pay claims. If a company that is in the admitted market fails, then they have access to the guarantee fund.
So if the RRG wants to expand their coverage, which I'm hearing today, why wouldn't they just become an admitted carrier? Why wouldn't they go through? Are they being barred from that process?
They are not being barred from that process, and as has been mentioned here today, if they found that there was an issue in a particular state, they have gone to that particular state's insurance commissioner and asked that this issue, whatever the issue may be taken care of in that particular state, and that's what has happened in the past.
Ms. Davis, did you want to join in?
I did, thank you very much. I wanted to talk a little bit about the guarantee fund issue. We have always said, as we work through this legislation, that if Congress wanted us to be part of the guarantee funds at the election of an insurance commissioner in a state, for the benefit of writing the property insurance, we would be happy to do that. And we've always said that, and so we would be happy to do that if that's something that you feel strongly about. I would also like to speak a little bit about why we cannot become admitted, if you don't mind. We did actually look into it. We've looked into every option we can possibly imagine to try to solve this problem before asking Congress to fix it. And I did call an expert and suggested to him what we were planning to do, what we were hoping to do, And honestly, he laughed at me. He said, this is ridiculous. The path to being licensed and admitted for this small amount of property you're talking about for these little organizations just simply makes no sense. Nevertheless, we looked into it. But there is a specific reason why Alliance of Nonprofits for Insurance cannot become licensed and admitted. And the reason for that is that we're actually a 501c3 nonprofit ourselves. As an insurance company, there's a certain law, it's a federal law, it's called 501N under the IRS code. And we are tax exempt under that IRS code. And it requires us to be organized as a nonprofit under state laws provisions authorizing risk-sharing arrangements for charitable organizations. There are only 6 states that allow that, and so we could not be licensed and admitted in every state.
Thank you, Ms. Davis. Mr. Bergner, did you want to add your thoughts on this matter?
Sure. I think we've seen in the past that there have been several risk retention groups that have indeed reorganized to become admitted carriers. I'm not familiar with the specifics of the federal law that Ms. Davis was referring to in terms of the inability to reorganize, but we might be happy to help try to amend that law if that were the desire to try to streamline the process for becoming an admitted carrier and then therefore playing by all the same rules. I would just note that the NAMIC membership is a great example that sort of belies the notion that you can't be an admitted carrier operating as a mutual in niche markets and be small with specific risks, because that's what our members do every day on Main Streets across America. So I would just leave you with that.
Yes, Ms. Robinson, I have 30 seconds and you can have them all.
Sure, I just want to add that when you talk about the guaranteed funds, that's the notion that an insurance company or RRG goes out of business before that ever happens. We've noted that that's never happened in history if they've been in business over 10 years. Furthermore, I come from California. You've seen the wildfires that have occurred. In the last couple years, the only company that has gone out of business has been a traditional insurance carrier out of the Camp Fire and Paradise Fire. So, and they are regulated, and they are backed by California Guarantee Insurance Funds. So I just want to say that I'm just astonished at the fact that that's the fear-based kind of notion that we're hearing today, as opposed to the realities, which risk retention groups do not face.
Thank you. The chair now recognizes gentlewoman from Michigan, Ms. Tlaib, for 5 minutes.
Thank you, Mr. Chair. Thank you all so much for being here. I appreciate coming from the nonprofit sector, kind of critical conversation of how do we cultivate an environment that allows so many nonprofits across the country, especially in 13 districts strong, to really, in some way, supplement for what government isn't doing enough of. And so I wanted to ask Ms. Robinson, it was a study that found in 2017, found that nonprofits have very few options when it comes to obtaining property insurance coverage, especially small, mid-size. One of the things I wanted to ask is it just property insurance? What else does nonprofits need insurance for?
It's certainly not just property insurance. They need insurance for abuse liability. They're often dealing with vulnerable populations, such as children and the elderly. They need coverage for directors and officers' liability, as they cannot form boards. A lot of people want protection in order to get that coverage. Volunteers, they're the primary type of organizations that have mass amount of volunteers, and so they have a unique type of insurance and risk exposure on that front, different than the for-profit community.
So, and Ms. Lindley-Myers, there's been, and Mr. Is it Bergner? Bergner. The same study, I think, showed that nonprofits, particularly smaller nonprofits, have limited access to property insurance coverage because the bundling or something. Can you guys explain to me what that is and how this? So there's been some arguments that this coverage is amply available, and I know you guys have been kind of going back and forth about this. But if my mom's right now watching this, explain this in the simplest form. It's important for people to understand in a much more simple way of why there's some disagreement here and what are some of the core issues.
Sure. Thank you, Congressman. I appreciate the question. So yeah, there has been a lot of discussion around bundling. This is something that insurance companies will typically do in the marketplace because it's more efficient and cost-effective to bundle two or more
Do
different.
they like make more money doing it that way, or?
No, it typically provides savings to the consumer. This is something that the consumers in the marketplace have desired, and so you'll see it quite frequently if you turn on the TV and look at bundle your home and auto. So that's in the personal line side. In this case, the conversation is about bundling your liability and your property, right? Okay. So, and so this is what consumers typically are saying they want, and so that's what many in the market tend to offer. I would just note it's a little the kind of attack on bundling that I at least have heard throughout this debate is a little odd, considering the purpose of HR 4523 is to allow for bundling by risk retention groups. So.
And I would agree with Mr. Bergner, but I also want to draw your attention to at least the executive summary indicates that bundling is preferred because it is efficient, and it allows you the carrier, or it allows, in this case, a nonprofit, to put all of that together. I've heard conversation about monoline. We just need property. We just need property. But the efficiency is in bundling, and that is, the rationale for that.
I'm sorry, I'll get to you, Mr. Hunter, you have something to add?
Well, I think the problem with bundling is the liability part of the bundle of business owner property liability policy has liability in it, but it's not the kind of liability that's
less
needed by
coverage?
the nonprofits.
Is it less coverage?
It's coverage. It's liability coverage bundled with property, which is efficient for most people. But if the liability part doesn't offer what you need, you don't want a bundle. You want to go to your risk retention group, your RRG, which gives you exactly what you need, which covers the kinds of risks you have when you're dealing with volunteers and when you're dealing with the elderly and you're dealing with sexually abused people and really difficult risks. You have to have tailored coverage. So the RRGs offer the tailored coverage. They'd have to give that up if they went to a bundle. They don't want to give it up.
Got it.
They want to add property insurance, and that's what the bill
Got a lot of
does.
options there. And go ahead, Ms. Robinson.
Yeah, I just want to add that when you talk about a bundled program, as discussed here, those insurance companies have one idea of what they want to write, very black and white, in this little underwriting box of the type of risk they want to insure. So if there is an organization, as I was discussing earlier today, like Black Lives Matter, where they don't want the liability, they're not offering any coverage, because what they're approved for is this one bundled option, further limiting the options that nonprofits have. And again, I see this, I'm on the ground, I work with nonprofits for a living, I'm talking to them every day, and I do it for
Thank you. I can see my vice chair has learned a technique from Chairwoman Waters with the clicking, so I heard you. Yes. Thank you so much. I yield.
The gentleman from Tennessee, Mr. Kustop, is recognized for 5 minutes.
Thank you, Mr. Chairman, and I don't know if anybody has stated this, but I would like to recognize our former colleague, Mr. Ross, who is here today in the audience, and it's good to see him, and it was good to visit with him a week or so ago. And also to Ms. Lindley-Myers, Commissioner, Director, appreciate you, remember you from your days in Tennessee and your public service, and we certainly do appreciate it. Appreciate all the witnesses being here today. Mr. Bergner, if I could, we've heard everybody's opening statements, and as it relates to data, can you give us any evidence, if you will? Is there any conclusivity as to whether there is data to support an assertion that nonprofits have difficulty finding commercial property insurance at affordable rates?
Sure, thank you, Congressman. I can at least address just a couple of points in that space. The first is, according to the Urban Institute's nonprofit center, there's upwards of, I think the latest numbers are 1.56 million nonprofits, 78% of which are 501c3s, which would put that number over 1.2 million. We generally, in not seeing a crisis, and I would echo or acknowledge my colleague Director Lindley-Myers' point that the state insurance departments are not really seeing folks coming to them and expressing a crisis of availability. And so with that kind of number and at the overall level, and granted not all of them may need property insurance, conceded, stipulated, but one would think this would be a lot more obvious than it is. And then the second point, I know there's a lot of discussion surrounding the Guy Carpenter study, such as it is, that sort of is to demonstrate that there is no availability. I can't really comment on kind of an assessment on that. It's the only thing that, to my knowledge, has ever been released is a 2-page document summarizing a survey that was done. And without any of the assumptions or search parameters or underlying data, I wouldn't feel comfortable being able to rely on that to change federal statute. So generally speaking, we don't think there's a lot of, what word you use, conclusive evidence to suggest there is a crisis.
Do you have any concern as it relates to the bill that we're talking about and that's being considered? Do you have any concern about the bill's regulatory approach and how it could ultimately, or could it ultimately increase policyholders' risk exposure?
Well, we do, and I mean, in my opening statement, you know, I sort of raised the issue of, by definition, you know, being substantially regulated only by your state of domicile means less oversight by fewer regulators. That's just inherent in the regulatory regime. So I think our membership would say this is a false choice. We don't have to choose between consumer protection and availability. We can have both. We've had it for 200 years, you know, with many of our companies. So,
thank you. And Director Lindley-Myers, if I could, with you, with your time in Tennessee as the deputy commissioner, do you have any thoughts about whether a state like Tennessee could face risks not understood by, say, the insurance regulator in Vermont if this were enacted?
I would say that having a RRG that is domiciled in Tennessee, I have no control in Missouri because I'm a non-domiciliary state. So any state that is the non-domiciliary state would have problems monitoring that RRG, knowing what's happening. We can't do market conduct exams. We don't know their financials. And in looking at a report from risk retention reporters, when you look at the 10 to 15 year range, according to that, there were 8 that were insolvent. 1 was for 15 years or more. And so what you're looking at is the ability of that risk retention group to operate and try to operate in some other jurisdiction that they know nothing about.
Thank you very much. And my time is expiring. I'll yield back my time. Thank you to all the witnesses for appearing today.
The chair recognizes the gentleman from Tennessee, Mr. Rose, for 5 minutes.
Thank you, Vice Chair San Nicholas and Vice Ranking Member Gooden. I ask unanimous consent to enter into the record a letter from the Coalition Organized for the Future of Insurance Regulation expressing opposition to H.R. 4523, the Nonprofit Property Protection Act.
Without objections.
Nonprofit organizations are often the lifeblood of the communities in which they serve, but the issue at hand here today really boils down to expanding risk retention groups and necessarily expanding the federal government's role in regulating insurance markets at the expense of our state-regulated regime. Yes, in rare instances, Congress has acted to address insurance crises, but that has been when the size and scope of a problem rendered state-based solutions infeasible. One of these rare instances was, as we've heard expressed already, the creation of risk retention groups in 1981 in response to the problems in the liability insurance market. And we can know the scope of Congress's intent when it created these risk retention groups by reading the accompanying committee report. Risk retention groups were not required to participate in insurance insolvency guarantee funds because risk retention groups are not full-fledged, multi-line insurance companies, but limited operations providing coverage only to member companies and only for a narrow group of coverages. You have a lot of entities that started out with a very narrow purview, and then they want to get beyond that narrow purview. Ms. Lindley-Myers, does H.R. 4523 allow risk retention groups to combine commercial property and liability insurance similar to what admitted insurers would do?
No. I mean, yes, they do, but generally speaking, if there is an issue as far as a risk retention group, at least as it relates to Missouri, and certainly in my time when I was in Tennessee, you're able to get it from the admitted market. If you can't get it there, we usually go to the surplus lines market. If you can't get it there, there is usually a residual market in which we can kind of go and get coverages for. So I don't, that's why I am staunchly believing that there isn't that kind of an issue, because there are other services that are out there that go to the surplus lines. Uber is one that goes to the surplus lines market. It is not the same as taxi cabs or whatever, and so they actually have a marketplace to go to.
In your opinion, would this expand RRGs beyond what Congress originally intended when they were first created?
In my opinion, yes.
After speaking with officials in Tennessee about risk retention groups in general, I have to admit I'm concerned about opening RRGs up further, and our state officials share those concerns. The fact is, not only have our state officials not heard any concerns from nonprofits regarding the availability of commercial property insurance, but they are reevaluating at a policy level whether or not more RRGs should be allowed in the first place. And they are very concerned about the lack of consumer protections for RRGs compared to admitted insurers. In Tennessee, 2 of the 7 RRGs operating in the state are under enhanced supervision because they haven't worked out well. Mr. Bergner and Ms. Lindley-Myers, do you know of any state in which commercial property coverage is unavailable to nonprofits?
Not to my knowledge, no.
No.
Are commercial insurers abandoning these nonprofit markets?
Not to my knowledge, no.
As it relates to Missouri, no.
Ms. Lindley-Myers, is it true that if this crisis did exist in a certain state, then state regulators could step in to reform how state-admitted insurers sell both property and liability coverage and make these products more accessible?
That is correct.
In the NAIC's comment letter that I mentioned earlier, it's mentioned that the criteria to demonstrate coverage liability is illusory. What does the NAIC mean by that?
Sorry. In each state, what we're looking at is that's why RRGs might be problematic. Each state has its own requirements, and that's what admitted carriers follow. And and those requirements allow for consumer protections. It allows for especially if an admitted carrier or a surplus line carrier is operating in more than one jurisdiction, it allows multiple eyes to look at that and assess.
Thank you. Our time has expired. I yield back.
The chair now recognizes the gentleman from Missouri, Mr. Lindley-Myers, for 5 minutes.
Thank you, Mr. Chairman. Welcome, Ms. Lindley-Myers. Good to see you again, fellow Missourian. You know, I spent 30-plus years as an insurance agent, was in the business for a long time. My son has my agency, and so I'm kind of aware of kind of what some of the issues you're talking about here. It kind of concerns me a little bit by the way we're leading discussion here from the standpoint that, you know, we have a group that, when I was an agent, we tried to find places for nonprofits in my trade area. I tried to do this as well, so I understand your problem, and I'm not against risk retention groups, but I think if but for a good business practice here, for a good company to exist, it takes sound underwriting, it takes adequate capital, and you need to have a reinsurance program. Do most of these RRGs, or all of them, have reinsurance? Mr. Bergman?
I don't have any specific information on that.
Ms. Davis?
Yes, absolutely. We have extensive reinsurance just for.
All of them that you're aware of have reinsurance?
All of them that I'm aware of have reinsurance, absolutely. And many,
Okay.
many of them are AM Best rated as well.
Ms. Lindley-Myers, does everybody in Missouri have reinsurance?
If there's an RRG, to my knowledge, if there's an RRG that's operating within the state, it is not a Missouri-based, and they may or may not have reinsurance. It depends on the
Okay.
agency.
As a regulator, how often do you go in and look at the RRGs? Do you have oversight over them?
I have oversight over those that are domiciled in Missouri.
Okay. How often do you examine them?
Generally, it's on a 5-year cycle.
5-year cycle. Do they submit annual reports to you that you go over the annual reports? If you see something that's out of line, and can that trigger an examination?
That is correct.
What kind of capital problems do you see or have you seen in some of these RRGs, or have you seen any at all?
I'm going to say that I haven't seen any in the almost 3 years that I've been there, no.
When they have a rate increase, do they apply to you to approve the rate increase?
They do.
What is your concern as the regulator with regards to the marijuana situation, where a lot of these insurance companies now, and I'm sure that Mr. Bergner can attest to this too, this is a burgeoning problem. It's going to have to be underwritten correctly and going to have to be rated correctly. And it's going to be, to me, a really big problem in the future with rate increases for all insurance companies, not just RRGs, but across the board. But I'm sure RRGs are going to feel it just as much. And if you're a nonprofit and you're squeezing dollars, all of a sudden this is going to really impact, I think, an RRG. What is your opinion, Ms. Lindley-Myers?
I would agree. It is a concern. We in Missouri just started licensing agencies for marijuana, in various parts of the state. And we are having, as you know, I am also in charge of the financial institutions, which includes credit unions and banks. A lot of them don't want to do it. There's some reticence in trying to provide such coverages. Doctors giving people prescriptions for it. There's some issues. As you know, I'm over the professional registration as well, and so they're very concerned about doing so. And so if you're an RRG and you are doing that sort of stuff in Missouri, I'm keeping a watch on that, but I have no idea what the laws may be like in Vermont or California or some other place. And that's why, if you're the non-domiciliary state, you should be taking a huge interest in RRGs.
Well, this is a concern to me because I'm concerned that if you wind up with a lot of claims, are we adequately capitalized? Do we, do you have adequate? Most of them are not apparently in the guarantee fund.
Correct.
And then we need to make sure we have reinsurance to be able to pick up the company in case it struggles. And so, Mr. Bergner, what is your thoughts?
Well, you raise a very interesting, I think, emerging issue for the industry. Like most things, I think the private admitted market will adjust to these things. I don't think that market will adjust until we resolve the conflict between state and federal law.
So my concern with this whole thing is that if the RRGs want to go down this road, they're going to have to understand that they're going to have to play by a different set of rules than they're playing with right now, because you're getting into a whole different realm of different kinds of insurance. There are different kinds. This is liability, and property and casualty that's apples and oranges. And you have to have expertise in this, otherwise there's exposure there, which if you don't have that expertise, you're going to be in a big world of trouble. So with that, thank you very much for being here today, and I yield back.
The chair recognizes the gentleman from Ohio, Mr. Gonzalez, for 5 minutes.
Thank you, Mr. Chairman, for holding this hearing, and thank you to the witnesses for your participation today. Like a lot of folks on my side of the aisle, I believe in the state-based regulatory framework. I think that's served our country very well. It's certainly served my state of Ohio incredibly well, where we have some great insurance company, Westfield, Nationwide, Progressive, headquartered either in my district or nearby. And to me, the only time it really makes sense for the federal government to be intervening is when there's a clear market failure, like we've seen with TRIA or with flood. And I'll tell you anecdotally, we called, I don't know how many, we called a handful of nonprofits who would supposedly have this issue. We called the state agency the state organization that many belong to, asking specifically whether there was a hole in the market or whether they've been hearing from their membership about the issue that we're here to discuss today. I will tell you, nobody said they saw an issue, certainly not one that rises to the level of a market failure that would suggest that the federal government should take a look at it. So with that, I mean, as we know and have heard today, Congress created risk retention groups back in the 1980s to address what at the time was a crisis in the commercial liability insurance market, where some organizations at the time were unable to obtain adequate liability insurance because of the specific nature of their risk profile. And I think fulfilling that original purpose is fine, but again, if RRGs want to expand beyond this scope, in my mind, they would become admitted insurers with all the consumer protections that affords. It seems ironic that the proponents of the legislation who claim that it is about making a product cheaper and more available to customers are willing to bypass the capital and other regulatory requirements of admitted insurers designed to protect consumers. Mr. Bergner, am I incorrect here? I would imagine anything would be cheaper if the entity providing the product had an advantage over its competitors in the form of less regulation.
So, no, I would say you're not incorrect here. We've seen some studies that look into this, but the pricing benefits for risk retention groups flow directly from a relaxed regulatory regime. So in an insurance space, it's not possible to make a risk cheaper. To insure a risk, it is what it is, right?
That's right.
So that's the benefits flow. Academics have looked at it and suggested something along the lines of 26% reduction in cost directly from this different regulatory regime.
Yeah, which makes sense. And then, Ms. Lindley-Myers, in your testimony, you said that risk retention groups are prohibited from participating in state guarantee funds. What does this mean for policyholders should an RRG go insolvent?
If the RRG goes insolvent, the policyholders of that RRG has to look to the RRG for its claim payment, and if there's no money there, they don't get it paid. At least with a state guarantee fund, there is some funds that are set up to pay the claims.
Thank you. And then do you have any data on whether or not RRGs are more prone to insolvency compared to admitted insurers? Anybody on that? Director Lindley-Myers?
I guess I can just say, at least for, in 2019, the state of Nevada had to shut down a transportation RRG as well as a medical professional liability RRG. They both were placed in receivership in 2019. And the transportation one was the 8th largest RRG in 2017 with a reported premium of $66.7 million.
Wow. That's awfully telling. And then, Mr. Bergner, in your testimony, you state, ultimately, if there is an interest among RRGs in expanding into other admitted lines markets, there is an option that some have already utilized, which avoided an unfair and unlevel playing field while ensuring customers are protected. Can you discuss further why you believe it is better for consumers and for RRGs to reorganize as traditionally admitted insurance companies?
Well, certainly, and I think the conversation has been ongoing today at this hearing about, and I think Congressman Lindley-Myers made the point specifically, I mean, these risks are different, and it's important for the folks that are offering the same products to be playing by the same rules. And so ultimately, if that's not the case, you have what creates a competitive advantage that, you know, could theoretically lead to adverse selection concerns, obviously broader concerns, things of this nature. So we just generally, we think that the thesis of my testimony here today is very simple. Same products, play by the same rules.
Thank you, and with that, I yield back.
Gentleman from Ohio yields back. I recognize the gentleman from Guam, Mr. San Nicolas.
Thank you, Mr. Chairman. I yield the balance of my time to my colleague, Mr. Green.
Thank you for yielding, and thank you, Mr. Chairman, as well. Let's start with Mr. Bergner. Sir, you've indicated that you do not have these RRGs in your state, supporting entities in your state, is that correct?
Well, so we actually do have risk retention group members in our membership, yeah.
Yes, you have
We do.
approximately 40 in your state, including the big brothers and big sisters in your state. Ms. Davis, let me ask you now, with reference to the insolvency. You wanted to give a response. Would you kindly do so, please?
Yes, thank you very much. Just speaking about the regulation of risk retention groups generally, I think there's been misrepresentation because we have exactly the same capital standards to maintain solvency that traditionally licensed and admitted insurance companies do. There is no difference. And even I'm reading from the NAIC website right now that the NAIC accreditation program, under that, the regulation of multi-state RRGs is similar to the regulation of commercial insurers. We have to comply with the quarterly and annual requirements imposed on property casualty companies, including financial statements, manager's discussion and analysis, risk-based capital, audited statement, actuarial opinions. I could go on and on. We also have risk-focused examinations. We have additional governance standards. There have been many, many, many things that the NAIC has done over the last 10 years to make sure that the regulation of risk retention groups and the required capital is consistent across all states and the same for risk retention groups as for commercial insurance companies. And I am surprised to hear the representative from NAIC not take credit for all the work that the NAIC has done to make sure that there is uniform regulation. And the other states that are not domicile states have every opportunity. If they don't like the operation of a risk retention group in their state, they can ask for an examination by the domicile state. If the domicile state doesn't do that, they can actually do the examination themselves, and they can shut down that risk retention group in their state by taking them to court. So the regulation is very, very similar, and the capital standards are the same.
And let me move to Ms. Lindley-Myers again, please. You indicated that you don't have any RRGs in your state. Is that correct?
That indicates that there's a crisis. There is RRGs in the state.
Yes, you're right, but that's not what you said earlier. And as a matter of fact, you have doing business with RRGs in your state, some 213 different 501c3s. Here's where we are. Currently, there is one company that offers the service that the RRGs would need, one. But the bill allows for certification by a given state that there is no crisis. The bill then allows for the RRG to cease and desist or not work in that state. But if it makes you comfortable, I'll be more than willing to amend the bill to accommodate you in this area, to make it such that if there is an RRG functioning in the state, then it would have to exit the state. But I don't think that that's the problem, because it appears to me that the large insurance companies would rather see no RRGs. Let me ask you, if I may, Mr. Bergner, have you any experience with insuring these small 501c3s? None at all?
Personally?
Yes, sir. Any experience?
No.
And Ms. Lindley-Myers, do you have any experience?
With insuring them? No, I'm a state regulator, so I don't insure them.
All right. Now let's go to Ms. That would be Ms. Robinson.
Sure.
You have some experience?
Yes, I've been doing this for 15 years.
And in your experience, given that you have experience, are there difficulties in getting the insurance?
There are absolutely difficulties, and I heard the example cited here today that there's been some risk retention groups who've struggled. I just want to cite this narrow expansion of this law is for nonprofits. It's what we're talking about here today. So not other groups, but nonprofits. So it is difficult, and I know that they were cited.
You're the person who's had the experience.
Yes.
The others are giving us, at best, what someone else has told them. We call that hearsay.
Yes.
Finally, if I may, Mr. Chairman, I just want to ask one additional question. Is there any reason why an RRG should not move into this line of business other than you think that there is no crisis? I yield back the balance of my time.
The witness may answer if they choose. Davis, you can attempt.
I can begin. actually having insured through 30 years the liability insurance for nonprofits, and in California, we insure also the property through a different liability mechanism. We insure property and liability in California, and we've insured a liability for a very long time. It is much more difficult to insure this long-tail liability. We have sexual abuse cases that might come 40 years after the fact. The fact that little nonprofits have survived and being relegated to only insure the liability, that's the difficult line of business. And I have also insured property, and so I have very much experience with that, and it is a much more predictable line to do, especially for little nonprofits in the type of property that they have. We are not high risk.
Thank you for your response. Ms. Lindley-Myers?
Yes, I just wanted to make sure that, it's understood that it's the non-domiciliary state of these RRGs that has no view on what's going on with these RRGs that are capitalized in another state, and that it leads to less consumer protection, which is what my job is. And I've been been in regulation for 38 years. So I have seen what has been out there, and I have not encountered one nonprofit that has come into any of the states that I've been in, from Connecticut, Missouri, Kentucky, Tennessee, back to Missouri again, that has said, I can't find any coverage.
Thank you for that response. I will go to the gentleman from California, Mr. Sherman, who is also the chair of the Subcommittee on Investor Protection, Entrepreneurship, and Capital Markets. Is now recognized for 5 minutes.
As the gentleman from Ohio pointed out, we have a system of state-based regulation of insurance. I think that's worked well. It was tested in the 2008 catastrophe to our economy. Most of the opposition to this bill, as far as I can see, is a fear of departing from that concept of state regulation. Ms. Bergner, I understand in my own state of, or Mr. Bergner, and I'll also address this to Ms. Davis. I understand that in the state that Ms. Davis and I share, California, they've already taken steps to provide a mechanism so that nonprofits can acquire commercial property coverage. Why can't other states simply do what California did so that we don't have to be here?
Well, thank you, Congressman. It's a good question, and when we talk about this, we talk about kind of a cascade of options for 501c3s, right? So starting in seeking to obtain coverage somehow through the admitted market, whether it's directly from primary carriers, having RRGs do fronting arrangements with other admitted carriers to figure out how to sell products where they need to. And then from there, the surplus lines market that we've talked about a little bit.
I'm gonna cut you short and go to Ms. Davis. You've talked to me about this bill and its concept for a long time. California solved the problem. What's the matter with these other 49 states?
So this is the reason that it works in California, because California is so geographically spread and there are so many nonprofits that we actually have enough nonprofits there to pool together and that we can do it together. But I don't think there's maybe one other state that this would make sense. It would be irresponsible for smaller states to try to do this with just the nonprofits in just the state.
So it shouldn't be limited just to a small state or two.
It has
to be multi-state, but you could very well have the states do this without the federal government.
It would not work.
Okay. In our state, we've got like 90-some thousand nonprofits. 20,000 of them have insurance through these risk retention groups. Are the others able to get coverage elsewhere, or what's happening in California?
So we've always said that there are other limited options for nonprofits for package coverage. We're talking about the absence of standalone property insurance. We cannot be the only carrier for nonprofits in the country, and we have no intention to be. I will tell you, across the country, we now insure in the states we're in about 7% of the nonprofits. And you say, that might not be a very large share. In California, it's actually 20%. But Berkshire Hathaway insures 6.5% of their market. We are a very important part of this market. Most insurance companies don't insure more than that.
You point out that these risk retention groups face the same kinds of regulation that you would if you were a mutual insurance company. But you're not regulated by every state in which you do business. And I understand that. I mean, if you were going to be a mutual, it sounds like that's the one advantage you have, and the cost of being regulated in every state you do business could be burdensome. On the other hand, I see that chart right in front of us saying 35% of the RRGs are in Vermont, and I don't think that's where 35% of the business is. My concern is Wyoming could have a hear no evil, see no evil approach to regulation. Somebody could be domiciled there and then do business in my state. I'm going to address this to Director Lindley-Myers. What do we do not to make these groups subject to registration in all 50 states, but register in those states where they do a tremendous amount of business, or a substantial, over half or over a third of their business?
The issue with the bill as presented is that the non-domiciliary state doesn't have the look-see of what's going on with that particular
And that's what I'm
RRG.
addressing. If you had the look-see, but not because they have one policy in your state, but because a third of their business was in your state, would that provide enough state regulation to these organizations?
If they're going to abide by the state regulation within my state, absolutely.
The gentleman's time has expired.
Can Ms. Davis give a quick response?
We'll get to Ms. Davis, thank you.
Okay.
Thank you. Let me recognize myself for 5 minutes. Ms. Robinson and Ms. Davis, a Guy Carpenter study from 2017 found that nonprofits have very few options when it comes to obtaining property insurance coverage, especially small and mid-sized nonprofits. Can you help us understand why it is harder for nonprofits as compared to other businesses to obtain the insurance coverage that they need? And we'll start with Ms. Robinson.
Sure, and I want to start by, I don't want to discount the fact that there are some nonprofits, more of the vanilla, very easy risk, who do obtain insurance and who do have options. The nonprofits that we're representing and speaking here today are those who are doing the hard work: homeless shelters, domestic violence shelters, foster care, vulnerable populations, the elderly, the mentally ill, the harder work that we all here don't do for a living. Those are who we're representing today. So the reason why it's harder for that subgroup of nonprofits to obtain coverage is because with these bundled programs, they have to do the liability and the property together. They're not looking at it as a separate risk. So if they say we don't want to be subjected to, for example, in a homeless shelter, the mentally ill or some sort of claim arising out of someone who might have a mental breakdown, then no, sorry, we can't do any of it. We won't do the property. The reality is they want a very black and white, only the vanilla risk, the easier risk to insure. And but for having this other risk, the option of the risk retention group, they are struggling. And I encourage the folks here today opposing this bill to get on the phones with the organizations who are on the ground, who are being subjected to the hard market and to these challenges.
And so, thank you for that response. Ms. Davis, they do provide a unique form of services which require probably some type of unique insurance coverage to help them.
Yes, absolutely. And the property insurance is just the part that our members can't get access to because it's available only as a bundled package, as we say, but the liability doesn't always work for them. And I've given many examples, and I would like to just say that there are organizations that have come to us recently. The Ann Grady Services of Holland, Ohio. They actually could not find any coverage. They have been operating since 1982. We were their only option. They have 400 community members that work for them. They're a large organization. Nobody would insure them. The Children's Shelter of San Antonio, Texas, they could not get anything because they were insuring foster family agency organizations. Sun Ministries in Minnesota, they came to us. No one else would insure them because they work in the inner cities. Mountain True, it's an environmental organization in North Carolina. They said they have been canceled twice, and they were so relieved they could finally find coverage with us. And then finally, Mid-Delta Community Services, Southeast Arkansas, they had an increase of $200,000 from their insurer, and they could not come up with that additional money. Their insurance broker went to 7 other carriers and got turned down. He could not find anybody to cover them. This nonprofit then advertised in the newspaper because they were desperate for anybody to insure them, and their insurance broker found us at the last minute. They provide Head Start to 7 counties in their community, and we were the only ones that would insure them.
And that's all about essential services that our entire community depends on. Ms. Davis, risk retention groups currently make up a relatively small portion of the commercial liability insurance market, with only 1% of the total premiums. If H.R. 4523 were to become law, how much do you think risk retention groups would grow? How many more would there be?
I actually think that there are not many more risk retention groups would grow, but I think the measure is the impact this would have on the nonprofit sector. So let's look at the fact that it's not 1% of the market, but for us right now, we insure 7% of the market. And in fact, we actually insure 13% of the nonprofit organizations in Missouri. So there must be more of a problem there than the commissioner is aware of. We insure a very large portion of the nonprofits in Missouri. So I think that the difference will be the impact on the nonprofit organizations. The insurance industry is not going to feel the impact of this, but the nonprofit organizations are going to be able to do their services.
And I thank you for your response, and I would hope that when this hearing is concluded, that the two sides could get together and find some middle ground on this issue. Help us here. Help us with this process of making sausage. At this time, I will recognize the gentleman from Florida, Mr. Posey, for 5 minutes.
Mr. Bergner, it's been said that allowing risk retention groups to offer property coverage to nonprofits means that the traditional insurance companies will face competition from risk retention groups. I like competition, but please explain how this might create unfair competitive disadvantages to traditional carriers and the impacts of those disadvantages. And I know this is similar to another question. I'm just looking for some more specifics.
Sure. So, yeah, I mean, at the end of the day, we've heard a lot of discussion about it's a different regulatory regime, but not, it's equivalent in some way. Well, the fact is, it's not an equivalent regulatory regime. And if it were, well, there's got to be a reason there's a staunch opposition to becoming an admitted carrier, right? So there's a reason that regulatory regime is more preferable to operate under. And some of the provisions of H.R. 4523, for example, that seek to address some of the potential regulatory concerns, we don't think necessarily get there. I mean, when a non-domiciliary state, per Director Lindley-Myers, wants to take a look at something or doesn't get the cooperation from the domiciled state's regulator, they have to take them to court, and it's legally questionable in many cases whether LRRA would allow for that court to find in favor of the state of domicile. So,
Congress created risk retention groups and shielded them from state regulation in all states where they offer coverage to address the perceived crisis that there was when commercial firms had difficulty obtaining product liability coverage. In this attempt to expand the role of risk retention groups to property coverage for nonprofits, there appears to be no such crisis. Can you tell us about the availability currently, and if in fact we are facing a quote crisis?
Sure, thank you. So we don't believe we are facing a crisis, and you know, speaking to specifics of anecdotes, I can't do without, you know, more knowledge about specific circumstances. But to offer my own, you know, anecdotal story about speaking to independent insurance agents, who I would note are also opposed to this legislation, they seem to have a lot of conversations with their membership, and they have not reported any similar crisis when they go out into the market. They say sometimes it's difficult to find, but we can find it for them. I would also note that the admitted market is just one of the options for a 501c3. There's the surplus lines market, there's residual risk market mechanisms like fair plans in many states. I did a cursory Google search of 5 of them in preparation for this hearing and found commercial property standalone coverage through these residual market mechanisms. So there are options that would suggest there's no.
Okay, I got another question for you, then I want to go to Ms. Davis. But I've heard from an RRG that there's simply no way that they could restructure as an admitted carrier because they simply wouldn't be able to offer their products to their clients at reasonable prices. But as I understand it, your membership has a number of smaller carriers selling policies to diverse clientele, many times for niche markets. So my curiosity is, how's that working for them?
Well, you know, come on in, the water's warm. Our membership has been doing this successfully for, in most cases, over 100 years. And there are folks that write for niche markets exclusively for houses of worship and related ministries that these organizations do in all 50 states. And so there are plenty of examples of companies that have figured out how to do this successfully to the benefit of their policyholders across the country.
Okay. Ms. Davis, you want to comment?
Yes, I did. First of all, we have a special condition. We cannot become a licensed admitted carrier because we're a 501(n) organization under federal law, and it requires us to be organized as a nonprofit under state law provisions authorizing risk-sharing arrangements for charitable organizations, not to be a licensed insurance company. So we would be bankrupt if we were able to do that. However, I wanted to point out that this is a crisis, and you're going to be hearing about it. If you don't believe me, you'll hear about it in the future. I have a statement here from Peter Pasuti. He's the managing director of Gallagher, which is of the nonprofit practice at Gallagher. He has written, and this will be published very soon, he says, Gallagher believes an insurance crisis is now for many nonprofits. They're a large broker. This is not a one-size-fits-all reaction to pricing and terms in the market. Is not hardening consistently. Certain geographic areas like the Northeast, Southeast, and Texas are experiencing reduced limits, as much as 40% rate increases and even non-renewals. I have another email about a conversation with a broker just today who indicated that the largest insurer of package coverage for nonprofit organizations in the country has said that they will be non-renewing their foster care, their adoption, and all their residential business.
Thank you. The gentleman from Florida's time has expired. The gentleman from North Carolina, Mr. Budd, is recognized for 5 minutes.
I thank the chairman. Mr. Bergner, again, thank you for your time and for each of you for being here. So is there any real evidence that a high percentage of nonprofits across the country that are uninsured or are shutting down or failing because of the high cost of insurance?
We have not seen any compelling evidence to suggest that's the case.
Do you think that this is perhaps just a way for a less regulated entity to sell a product at a cheaper price?
Well, that would be the result of the pursuit of this particular remedy in H.R. 4523, yeah.
So that really wouldn't be a very level playing field, then would it?
No.
So let's talk about McCarran Ferguson for a second, which is jeopardized by this bill being considered. So taken from the NAIC website, this is a quote, the McCarran Ferguson Act declared that the continued regulation and taxation by the several states of the businesses of insurance is in the public interest, and that silence on the part of the Congress should not be construed to impose any barrier to the regulation or taxation of such businesses by the several states. It affirmed from then on that, quote, no act of Congress shall be construed to invalidate, impair, or supersede any law enacted by any state for the purpose of regulating the business of insurance, end quote. So, in my view, if there was a crisis, then state regulators could step in to to reform how state-admitted insurers sell both property and liability coverage, and they can make these products even more accessible. So we should not create a nationwide loophole to allow these risk retention groups to do something that is best handled in the state level. And then that would also jeopardize the state system of insurance, which is, by the way, the gold standard of the world. So, Mr. Bergner, much has been said today about a Guy Carpenter study taken over 3 months in the summer of 2017, which looked at Insurance's Service Office, or ISO, filings concerning the availability of a standalone or monoline policies covering commercial property and auto coverage. So what I don't think has been talked about nearly as much as it should be is the fact that the folks asking for this study to be performed did so in search of the answer that they received. Just like HR 4523, in my mind, this question was a solution in search of a problem. So, Mr. Bergner, would you agree with my assertion here?
Well, as I mentioned before, it's hard for me to offer a real assessment of this study in that it's only been a 2-page document that's released with sort of the conclusions. I would, admit I found some of the language in that document oddly specific, and so I would want to dig in a little bit to the search parameters of this survey, understand the underlying assumptions and the data that was produced. If, of a type searched, the language that was used was of a type used by 501c3 organizations. I don't understand exactly what that means or how you would define a search by that. And so I would want to understand that a little better before I would be, eager to rely on that as the basis for changing federal statute. Regardless, the survey does not discuss, I think, perhaps some more interesting questions that could be asked along the lines of how are the other 1.2 million 501c3s transferring their risk successfully today in the market. And so this doesn't address that or any of the various options that one might have outside of monoline coverage in an admitted market.
Very good. Mr. Chairman, I yield back the remainder of my time.
I thank the gentleman for yielding back, and I'd like to thank all of our witnesses for your testimony today. As I mentioned earlier, I would love to see both sides to leave this hearing and come up with a working document to present to this committee, because I have a feeling that this issue is not going to go away and that we will persist. And hopefully we can find middle ground on the two sides and realize that this is an important issue and we do need to take care of our nonprofit community. So I would hope that we could, that you could get with the sponsor, the House sponsor, and find a way forward. And with that, without objection, all members will have 5 legislative days within which to submit additional written questions for the witnesses to the chair, which will be forwarded to the witnesses for their response. I ask our witnesses to please respond as promptly as you are able, and without objection, all members will have 5 legislative days within which to submit extraneous materials to the chair for inclusion in the record. This hearing is adjourned.